Hi everyone, welcome back to Financial Analytics online session. In today's discussions, we are going to handle something called as financial modeling. Now, as you all know, that modeling is a kind of a model creation by using some softwares like SPSS or MS Excel, through which we can do a financial forecasting. And today's session is all about models. So before we get into the today's discussions, let us see what are we going to see exactly the today's discussion. I've shown you a three picture. Possibly you can able to connect these three. For better understanding, the first picture talks about the income statement of a company. Second statement talks about the balance sheet of a company, asset and liabilities. The third picture talks about the cash flow analysis. Yes, today's discussions, these pictures are directly connecting income statement, balance sheet, and as well the cash flow statements. We'll see what is it. But before that, let us quickly recall the points that we have discussed in the previous session. The first thing what we have seen is the different types of financial models, under which we have seen the bottom three financial models. Number one is the budget model and forecast model, option pricing model. The budget model talks about how a company can create a budget for their day-to-day expenses. That model is a ready-made template available in the open platform, which the company can able to make use of that. The forecast model, which will help you in the operations point of view, you can able to forecast your figures like income, revenue or profit, or maybe the futuristic sales oriented kind of things, that everything that you can able to forecast in this model. The option pricing model is exactly a derivative model where you can able to get the price of futuristic product. So these three things that we have discussed in the previous session, and today's session, as I already mentioned, we are going to see something related to the income statement, balance sheet and cash flow statements. There is a term in the financial analytics called as three statement model. So what is that three statement? Just before we have discussed the three models, which are income statement, balance sheet and cash flow statements. These three statements are combinedly called as three statement, and model can be generated with the use of these three is called as three statement models. This model is very important in the financial analytics, since it is a basic and as well help to grow in the next level of model development, like your discounted cash flow model, merger and acquisition model and leverage buyout model. These three models are in the advanced level. To achieve that model, like a discounted cash flow, leveraged buyout and merger and acquisition, you require mandatorily to have a three statement model. Let us see how we can integrate these three models, income, balance sheet and cash flow, together, so that it can be a base for your next higher level of model development like DCF. This combination of income, cash flow and balance sheet model, commonly we call it as a three statement model, help to analyze the scenario management and sensitivity analysis. What is a sensitivity analysis? How this will relate with your financial analytics model development? Imagine a situation, a pen cost 10 rupees. Manufacturing cost is, let's say, 10 rupees. The pen currently market selling price is 25 rupees. So the 15 rupees is a profit. What if the manufacturing cost increased by 20%? Means the manufacturing cost is now no more 10 rupees, it is going to be at 12 rupees. Will the company increase the price of a product keeping the same profit? In that case, the price of a product will be no more 25, it is going to be at 27 rupees. So 2 rupees of incremental in the price of a product, what kind of ripple effect will it create in the market? How the people are, to what extent people are sensitivity towards the price variation? That is what a sensitivity analysis. To do a sensitivity analysis, you require three statement model. A second one, a scenario analysis. A scenario is a kind of a situation. For every situation, you have a pros and cons. Imagine company is firing 100 employees, maybe due to the non-performance of employees. What will be the ripple effect in the market? It may be of higher end, or it may be the bottom side, or maybe the positive side of company's reputation, throwing the non-performing people out, or on the other side firing their own employees because of not able to extract work from them. So scenario analysis talks about a situation. What if the company is planning to go for a new product? Will it have a better positive impact in the market, or negative impact in the market, or neutralized? Scenario analysis. To do a scenario analysis, you require three statement model. And this model, in fact, you can able to do it very easily. A ready-made template is available on the open platform. That is an Excel based template. You can simply download and use it for your basic workings. And that template is error-free template. So you can rely on the template that is less of risk involved in it. Let us see how we can able to do it. There is a step-by-step process. To start with, of course, you need to collect the past data, historical data. See, that is the base of any forecasting, right? If you want to do a forecasting, you require a historical data, descriptive analytics. So you need to collect the past data like previous income statements, previous balance statements, previous cash flow statements. But the question here, how many years do you require? There is no standard rule on that. As long as you have more years or more number of data, your prediction accuracy will increase. Instead of 5 years, if you have a 10 years, yes, that's well and good. You can have a prediction accuracy in the higher level. But if you have only 2 years of balance statement, you cannot expect the higher level of accuracy in the prediction. So there is no standard thumb rule saying this many years of data is required to go for your prediction. No. So as long as possible, maybe as soon as possible, you can collect the Humpty number of the previous data like income, balance sheet and cash flow statements. Once it is done, the next step is to start assume something. See, we already seen the basics assumptions behind the forecasting, right? How we do the basic forecasting? We assume the market scenario will continue as it is today. There will not be any drastic change in the economic. Whatever be the economic conditions as of now, that will prolong for the next 1 year or 6 months during our forecasting period. So that is the basic assumptions. Likewise, start assuming yourself like your product price, economical conditions, competitors analysis, market conditions, so pest analysis. So all those things that you need to assume as it is now. Once done, what next? So you have collected the basic data, you have started assuming the basics of forecasting. So start applying all those informations in the three statement model. To start with your income statement forecasting. So while you are applying the past data in the income statement, that will give you the projection list for the next 6 months or 1 year, whatever the period that you are looking for. That will give you income statement forecasting. Once income is being forecasted, that income statement is linked with your balance sheet. So that you can able to call this as a capital asset forecasting. You will try to forecast your balance sheet. So balance sheet, you have both assets and liabilities. Based on the previous historical data, you can try to project the assets and liabilities in the future. Then the connections of income sheet and balance sheet will lead to preparation of your cash flow statements. See, there is a difference between income and cash flow. Please keep it in mind. In the income talks about as a document paper, whereas cash flow is the revenue generation, actual cash inflows in the company. But income statement talks about in the paperistic one. So when you connect the income statement with the historical data, that will give you a projection list, and based on that projection list, your balance sheet will be linked. You can able to project the asset and liabilities in the future, which finally leads to your cash flows. Of course, any company is looking for a cash flows for basic day-to-day operations, and you can able to project it with this 3-statement model. Once you are done with the 3-statement model, you can able to go to the next level of discounted cash flows and mergers and acquisition, whatnot. You can able to do wonders by using this 3-statement model. So the basic of the 3-statement model is done. The next class I will show you a live workings on how we can able to download this 3-statement model from the internet, how we can able to do the workings. So before closing, so let me try to assess how you understood the concept of 3-statement model. The first one is a question to you. The DCF model is part of a 3-statement model. DCF model is nothing but discounted cash flow model is part of a 3-statement model. What is your opinion? Is it true or not? So based on your answers, we'll reassess myself. Okay, fine. People have understood or not. So we can able to get a judgment. So we will discuss this in the regular classes. So to summarize the discussion so far, first thing is we have seen the basic concepts of 3-statement model, which is a combination of income statement, balance sheet and cash flow statements. So these 3 statements linked together called as a 3-statement model. And last we have seen the steps in creating the 3-statement model, starting from data collections from the past history, then assumptions in the forecasting model, linking the model in the income statement and connect to balance sheet. Finally we will give them with the cash flow models. So this is what we have discussed in this class. We will see the live workings in the next class. Hope you understood the concept of 3-statement model and its applications in the industry. So with that note, I am closing. Thank you. Bye bye.